Assalamualaikum warahmatullahi wabarakatuh and good afternoon. In this series of lecture, we'll be looking at accounting for cooperation. Okay, what we have done before this is that firstly we have looked at sole proprietorship, where businesses are owned by one person. And then the second type of ownership was partnership, which is a business is owned by more than one person. Okay, so the third type of ownership is corporations. Okay, so we will look at in this lecture we will look at what is meant by corporation, what are the major characteristics of corporations, and then in terms of their equity, owner's equity, what is the components of owner's equity, and then we will look at the transactions regarding the equity, as well as the dividends and the share splits. So we will be looking at a corporate form of organization, or corporates, or in other words companies. A company is an entity that is separate and distinct from its owners, and it both has legal separation as well as economic separation. If you look at sole proprietorship as well as partnership, although the entities are economically separate, but they are legally not separate. Okay, so whatever is decisions or contract done by the owner in the under the name of the business will be binding on the owner themselves. Okay, but in the corporate form of organization, when corporates enter into a legal agreement with an external party, then that legal agreement is only binding on the corporation, but not on the shareholders, not on the owners of the company. That is the main difference. So corporations are separate from the owners, both legally as well as economically. But for sole proprietorship as well as partnership, although the organization is separate from the owners economically, but they are not considered as separate legal entities. Okay, organizations in the corporate forms, they are classified by purpose as well as ownership, because some corporates are, although most corporates are profit oriented, but there are also some corporates which are not for profit, but they are still corporates. They are separate from the owners, as well as the can be classified into the ownership. There are companies which are publicly held, as there are companies which are privately held. What do we mean by publicly held and privately held? A company that is publicly held, people can buy and sell their ownership freely in the market, whereas privately held companies, the ownership of the company is not traded, or it's not sold and bought in the open market, but is being controlled by the other owners of the company. Okay, we will look at the general characteristics of companies. The first characteristics is the separate legal existence. Secondly is the limited liability of stockholders or shareholders. Transferable ownership rights, ability to acquire capital, continuous life, corporate management, government regulations, and additional taxes. So the top 6 of these characteristics will be the advantages of corporations, but the bottom 3 will have its disadvantages on the corporation. So firstly is the separate legal existence. Like I said before, that corporations are separate in terms of legal from the owners. Okay, so whenever corporations enter into a legal agreement with other parties, the shareholders are not bound by that legal agreement. It's only the company. Secondly is the limited liability of shareholders. Okay, so what is meant by limited liability of shareholders is that whenever the company is liquidated and there are debts that the company needs to pay off the debt, the private property of the shareholders will not be disturbed. Okay, the private property of the shareholders will not be taken, will not be liquidated in order to pay for the debt of the company. Whereas in the sole proprietorship as well as the partnership, whenever those types of businesses wound up and they needed to pay for the debts, then the private property of the owners, the sole proprietor as well as the partners, will need to be taken, will need to be liquidated in order to pay for the debts of the business. And this is different from corporations. The third characteristic is the transferable ownership rights. Okay, so for sole proprietorship and partnership, the ownership of the business is not transferred. It's not easily transferred. So if the owner dies, then the business will cease to exist. Or if in partnership, whenever the partners change, then they will set up a new partnership. But for companies, people can freely sell their stake in the company to other people, but the company is still intact. Okay. Fourth characteristic is the ability to acquire capital. Corporations can obtain capital through the issuance of stock. So how does a corporate raise capital, raise equity? Is through selling stock or shares, and people can buy the shares to have a stake in the company. The fifth characteristic is the continuous life. So continuance is, as a going concern, is not affected by withdrawal, death, or incapacity of the stockholder, employee, or officer. Okay, whatever happens to the stockholders or the employees or the officer of the companies will not affect the going concern, will not affect the continuity of the company. The company still goes on even when the shareholders withdraw or there are death among the shareholders, which is not the same as in sole proprietorship and partnership. If any of the partners withdraw from the business or dies, then the organization ceases to exist, but they need to form a new organization. So these are the advantages of corporations. Next is the corporate management. Corporate management is the separation of the ownership from the management, meaning that those who own the company differs from those who manage the company. So the owners will appoint managers to run their business, but the managers themselves are usually not the owners of the company. So there's a separation of responsibility. One party is the investor and the other party is the manager of the business, but they usually are different. Okay, so this is an advantage, but as well as a disadvantage. The advantage to this is that the owners might not have the professional ability to run the business, but they appoint and they give salary to other people, to the managers, to run their business. Okay, so there's so you can you delegate your task of running your own business to some other people who have better expertise, but you will still get the profit that comes out of the company. But then there comes the disadvantage of corporate management. The disadvantage is that because you appoint another person to run your business, they might have their own objective, and sometimes their personal objectives is not incongruent with the objective of the business owner. Sometimes they may make decisions that are against the interest of the owners. So there comes a conflict of interest between the owners and the management. So there's a disadvantage in corporate management here. Next is the government regulations. Corporations are required to follow more regulations than the sole proprietorship as well as the partnerships. So they are required to follow the state laws, the Security Commission's laws, the federal regulations. So they are bound by more regulations than the sole and the partnership type of organizations. And lastly is the additional taxes. Corporations pay income taxes as a separate legal entity. In addition, stockholders pay taxes on cash dividend. In other words, there's you can say that there's a double tax there, because in sole proprietorship as well as partnership, the business do not need to pay tax, okay, but the income of the owners generated from the business will be taxed. So as if the owners will be taxed only once. But in corporations, the corporations themselves need to pay tax, and after paying tax, so in essence, with the paying of the tax, that will reduce the retained earnings or the income or the net profit attributable to the owners. And then from there, when the owners receive dividends, again they will be taxed. So the owners in fact will be facing twice the tax. Firstly is from the corporate tax on the net income of the company, and then tax on the dividend that the owner received from the company. Okay, so as if the owners are receiving or is incurring 2 times of tax.